Hello, and thank you very much for joining me today. My name is Emily Bolton. I am a CPA and certified tax coach. I am bringing you a fantastic video today regarding S corporations and results that can be derived from S corporations. Now, this isn't going to be a quick one, so there's just no way I can give you that kind of content, that kind of value, the understanding of the mechanics and the results that can be derived from this tax strategy in 5 minutes or less. So if you don't have the time to finish this video, I suggest you just put it aside and come back to it later. But if you really are determined to build a great business, or you already have built a great business, you owe it to yourself to watch this video, and I'll tell you why. As a tax and wealth coach, I get two types of new clients that come in. And they are those that are doing well in business and have been doing well in business for a while. I do a 3-year tax review on their situation, and I oftentimes, very unfortunately, find that they have been paying in too much tax for too long. In those 3 years, I'll see anywhere from small amounts between $1,000, $3,000, $4,000, but I'll see $5,000, $10,000, $15,000, even $20,000 that has been paid unnecessarily to the IRS and the various states. And that is absolutely tragic, because that is entrepreneurial wealth that's just being flushed down the toilets. No value being derived from that. And I'm all about that kind of entrepreneurial wealth, and looking into the tax code to secure appropriate strategies for my clients. Now, the other kind of client that I get is newbies, and they want to start a business, and they kind of start in the middle with this whole LLC. They want to be an LLC. Well, we have to kind of step back and take a look, and they often are being sold or have heard that they should be an S corporation. It's funny how the ones that really need it don't hear about it, and the ones that don't belong in it actually are being sold it. But for new businesses, the S corporation is not appropriate, and I am going to show you in this video for your own discernment exactly how that is. Now, this is so valuable. It's so valuable because it's going to help some folks realize that they have been unfortunately losing tax dollars unnecessarily, and it's going to help some newbies realize, oh wow, this isn't for me, but I'll know when it will be. I have the ability now to discern when I'm in that range. So it's so incredibly valuable, and I just ask that after you've watched it, and if you see there's value in it, please share this. It is really my heart to help small businesses stop wasting tax dollars. Those new clients I get to see on average $5,000, $6,000, $10,000, $15,000 a year just being wasted. It's tragic. It's really tragic, and it's unnecessary. And I want to do my part to help bring an end to that. All right, so I'm going to wrap up here, and I'm going to head over to give you a slide presentation. And again, I thank you for your patience with me as I learn how to deliver real value to you through these videos and hone my skills. Thanks a bunch. Have a great day, and I'll catch you on the slide side. Take care. Hello, I'm Emily Bolton, and I will be your guide through this slideshow presentation on S corporation elections, a core strategy in entrepreneurial wealth accumulation, a detailed look at a dynamite strategy. But before I do get into the slideshow, though, I want to quickly share with you a bit about me and why I prepared this presentation for you. I am a CPA and certified tax coach. My tax practice goes beyond traditional tax return preparation and focuses on entrepreneurial wealth creation and accumulation. My practice has evolved over time and is currently focused on serving the online marketing and entrepreneurs community, assisting them in wealth accumulation through proactive tax strategies and sound personal financial practices. I've been preparing taxes since the early 1980s while in college as part of an IRS's volunteer program. I went on to finish my college degree and earn my 3 years work experience at a Big 8 accounting firm. And while there, I've passed the 2.5-day CPA exam. which, for those of you not familiar, the CPA exam is the accounting field's equivalent to the bar exam, failure rates and all. I've hung out my first shingle in 1993, and quickly grew my tax practice. But it wasn't long before I realized what my clients really needed was tax planning. There's a big difference between preparing a return from historical data and proactively creating that history to derive a result. That result is huge tax savings, and that's what sets me apart from my competitors. And in this presentation, I hope to show you that. Setting up an LLC with an S-Corp election is one of the most dynamite strategies available to us today, and one that is core to my ability to save high-income clients an average of $15,000 in taxes each year. It's time for taxpayers to stop gifting the equivalent of a month's worth of their income to the IRS. Or think of it as the equivalent of a month's worth of time freedom, just forfeited. In this video, you'll learn how six-figure online marketers and entrepreneurs keep an average of $15,000 each and every year and convert federal and state taxes into entrepreneurial wealth. You'll know when and when not to use this strategy. One size does not fit all. Newbies will save $1,000 or $2,000 from day one by learning why this strategy is not for them. Folks, if you share this valuable video with your team and other marketers, you're going to gain instant credibility. They will love you for helping them save tax dollars. Some things to keep in mind. Reasonable compensation is the pivotal issue of this strategy. It's the hot red button with the IRS when it comes to S-Corps. Know that you are playing with fire when you handle this topic. S-Corporation tax return audits have increased more than 33% in the last 2 years and is being made a top priority by the IRS's Small Business Self-Employed Division. The potential for significant tax savings is a strong motivator to be unreasonable, thus leading to the high rates of tax evasion. The difficulty is that there is very little guidance as to what constitutes reasonable compensation. Unfortunately, this strategy may have a limited life, as Congress looks to fix the Social Security and Medicare system through elimination of it or significantly curbing its usage. Additional things to keep in mind. Reasonable compensation has no right answer, but it does have obvious wrong answers. Zero compensation for work performed is obviously unreasonable. Nobody works for free. Compensation under the poverty line when huge corporate distributions are being made is obviously unreasonable. Reasonable compensation should be competitive with what you would find in an independent employment arrangement. Reasonable compensation should be quantifiable and contemporaneously documented for the best audit defense. The rule is that reasonable compensation has to be paid to the S-Corporation owner-employee before non-wage distributions can be made. Doing otherwise will result in reclassification and pain. I want to start off with a nice, good representation of how the strategy works. Now, I know not everyone's comfortable with seeing numbers, so I've tried to keep the following slides consistent for your benefit. I have a common fact set, assuming a single individual, one exemption, living in Connecticut, which is my home state, with $40,000 of reasonable compensation. Now, I've chosen Connecticut because it has a state income tax, and it's one that piggybacks off the federal adjusted gross income like many other states. And the S corporation, oftentimes that tax strategy will actually result in a higher state income tax. Not a lot, but enough to warrant a look at. And I've also chosen the $40,000 reasonable compensation based on the fact that the average American national full-time salary has been between 40 and 46,000 for many, many, many years. And so 40,000 is a reasonable representation for purposes of this slide presentation. It certainly puts us in the ballpark. However, many industries would be different than this particular one. I am thinking of a tax analysis that I did 2 years ago. I did two of them at the same time. One was a janitor's service and the other was a dentist. And I think it's quite obvious that reasonable compensation for those two would be quite different. As a matter of fact, the janitor would be paid probably somewhere in the mid-20 to 30,000 would be a solid reasonable compensation. For a full-time in the fact set that I was looking at. And the dentist, well, it's hard to get that dentist below a six-figure reasonable compensation. So it does very much depend on the fact set at hand and the industry, the time, the experience. Quite a lot of factors go into that reasonable compensation. So let's look at the numbers. We have gross income of $150,000. We have expenses of $50,000, giving us net income of $100,000. So in the sole proprietorship, that net income of $100,000, that is subject to the self-employment tax of 15.3%, giving us the $15,300 you see in green on the left-hand side. That same fact set over as an S Corp, the 150,000 gross income, the 50,000 expenses, the net income before reasonable compensation of 100,000 allows us to pay out that reasonable compensation. So you will see the $40,000 being subtracted, leaving us with a net income of $60,000. This is where the savings can come from, by taking that net income of $100,000 and classifying it in two ways. One as compensation, reasonable compensation subject to the self-employment tax rates, or in this case, payroll taxes of 15.3%. So not all of the $100,000 is subject to those taxes. The net income, the $60,000 that's beyond the $40,000 reasonable comp, that can be distributed to the owner as a return on investment. And that portion would only be subject to the income tax for that individual, not subject to the self-employment tax. So the payroll taxes would be $6,120 for the S corporation situation. And you can see in the blue lettering, self-employment tax savings, $15,300 minus the $6,120 gives you a savings of $9,180 with an S corporation strategy. However, when we put this fact set through the various tax effects of the strategies, the net tax savings from the S Corp strategy is $6,769. So there are other treatments, other tax effects that happen in the strategy, and one of those being in this particular case in Connecticut, where the with an income tax is a higher state income tax. But I think that number was around $241 or something like that in this case. So not a lot, but some. I also am evidencing here the operational and organizational costs that an S Corp would would incur. So at a minimum, really, 1,000, 1,200, 1,250 is what I've selected here. That comes from perhaps some legal costs, accounting costs, and the various filings that would be required. There's additional tax return fees that would go into an S-Corp strategy. Perhaps payroll would be farmed out. Perhaps annual registered agent fees, bookkeeping fees perhaps. So I've gone on the real low side, if you will, not certainly the full service, full professional utilization, which could drive that number maybe up to 2,000 or so. So that brings our net savings with the S Corporation to $5,519. That's a great savings. Certainly something that would be of interest to clients. So in this next example, I wanted to be able to give you an indication of what that looks like at a lower net income level. So here I've selected 10,000 for net income. On the left-hand side, you can see the sole proprietorship treatment. The 10,000 is fully subject to the 15.3%. That gives us $1,530. On the right-hand side, the S Corporation, again, the net income before reasonable comp is $10,000. Reasonable compensation has to be paid out in full prior to any other form of distributions. So therefore, it's fully paid out. There's no net income that would benefit from a preferential treatment. So the full 10,000 is subject to payroll taxes of 15.3%. So you can see in the blue, the self-employment tax savings is 0. Now, the net tax increase from the S-Corp strategy, you're going to see a -9 here. And the interesting thing is, as you put these strategies in through the tax effects of the various forms and schedules, the S Corporation actually results in a slightly higher tax effect. And in this particular case, it's $9. When you get to, say, a $40,000 net income figure, that number rises to $33 of greater tax in an S corporation treatment. Very, very minor, but the point is it actually does have a slight increase in taxation S corporation treatments in the lower income levels. So again, we're going to take a consideration as to what does it cost to operate that S corporation. And you can see that we actually don't have the net savings. We actually have a net cost of $1,259. So it actually has given us no value to be an S corporation, but in fact has cost us over $1,200. And here again is an example with a net income of $50,000. So again, as a sole proprietorship, it's fully taxed at the 15.3 for self-employment tax. That gives us the $7,650. As an S corporation, on the other hand, we still have that net income before reasonable compensation of $50,000. We must pay out the reasonable compensation determined to be $40,000 in this example, leaving us net income of $10,000. So it's that $10,000 that has the preferential treatment. It's not subject to the 15.3. It's only subject to the income tax rate of the individual. So the self-employment tax savings in blue, that's $1,530. But again, when we put it through the tax effects of the various forms and schedules, our net tax savings from the S Corp strategy is actually only $812. Considering the cost to operate, we are still in a net cost situation. $438 of excess expense above and beyond the savings. Another example, net income of $75,000. We can see that
the effect on the sole proprietorship results in $11,475 of self-employment tax. However, on the S corporation, the payroll taxes only amount to $6,120. We actually have $35,000 of net income that can be treated preferentially. So our self-employment tax savings, that's in the blue, that's $5,355. That's very nice. But again, once we put it through the various forms and schedules and the tax effects therein, we have a net tax savings from S Corp strategy of $3,784 savings of taxes. However, again, we have the cost of $1,250 for organizational and operational expenses, but we do net to a savings. We net to $2,534. We obviously have passed the tipping point. We've obviously reached a place where we are deriving true savings from an S corporation strategy, which is really nice to see. So with the 40,000 reasonable compensation, we can see that that tipping point happens somewhere between the 50,000 net income figure and the 75,000. So that is why you will often hear reputable accountants say that, well, it's hard to say what that number is where you would want to consider an S corporation, but somewhere $50,000, $70,000, $40,000, $50,000, $70,000 is what you kind of might hear as a norm. But again, it goes back to that pivotal number. What is reasonable compensation? That is what is the true determinant, as I believe you can see. So here is a good chart to represent that, if you will. It is the sole proprietor and S Corp's total federal and state taxes at the various net income levels. You can see that there is no variation in tax results of the two strategies at or below the reasonable compensation level. It takes net income above the reasonable compensation level to produce tax savings with the S Corp strategy. But again, ultimate savings will depend on the costs associated with operating the S Corp strategy and the reasonable compensation figure that's been determined. Okay, so now I have a couple of slides that are based on a client that I first worked with in 2012. So I have 2 years of results. The first year is on the left, the 2012, and 2013 is on the right. I know the numbers. I know people tend to get all glassy-eyed here and like disappear on me. So I'm going to just make this very simple for you. The the left-hand column is without Emily's plan. It's as if they had not met me and they continued with the sole proprietorship as a Schedule C on their 1040 tax return, but using their actual numbers that they had in 2012. So had they not met me in 2012, their taxes, combined federal and state, you'll see in purple, $30,517 of taxes. Now, had I set up just an S Corp election, because I want to show you what an S Corp effect would be for this client with their fact set, which, by the way, is a married filing jointly, 2 exemptions in the state of Connecticut. So just an S corporation for them in 2012 would have resulted in taxes, again in the blue line, combined federal and state, of $22,805, which gave them an annual savings of $7,712. So the S Corp, you can see, is very valuable. $7,712 is fantastic annual savings. When we look to the right, 2013, again, that first column there is without Emily's plan. So it says their actual results for 2013 being treated as a sole proprietorship as they had done for all those years prior to meeting me. Their combined federal and state tax in the blue is $29,840. So had I set up for them just an S corporation election, their taxes, federal and state combined, would be $23,819. And so for the year, an S Corp strategy in 2013 would have saved them $6,021, giving them a combined total savings for the 2 years with an S Corp strategy being the $13,733. Well, my comprehensive proactive tax strategy investment, I look at it as an investment, is $2,500. That's what I charge my clients for this plan that I put together. So their net tax savings, net of my fees, was $11,233. That gave them a 2-year return on investment of 449% with an S Corp strategy. But I didn't stop there. Taxpayers are like snowflakes. There are no two alike. And so there really is no one size fits all. Their actual results relative to my plan look like this. Set up pretty much as it was in the prior slide. The left-hand column is without Emily's plan. It's a 1040 Schedule C sole proprietorship. Again, you'll see the $30,517 for the federal and state taxes combined. And with the first part of my plan, my clients only implemented part one. There were 2 parts to the plan. So in 2012, they actually only implemented one part. So their combined federal and state taxes that year were $20,340, giving them a total savings of $10,177 for 2012. 2013 to the right, again, their actual results, had they remained a Schedule C sole proprietorship in 2013, would have given them $29,840 of combined federal and state tax in the purple. And in the middle column there, you'll see Emily's full plan. So they actually incorporated the S strategy as well as a medical expense reimbursement plan, which I had set for them. And their taxes for the year combined was $17,767, giving them $12,073 of savings in 2013. So their actual total tax savings for the 2 years was $22,250. And again, my fees for the plan was $2,500. So their net tax savings, net of my fees, was $19,750. That gave them an actual 2-year return on investment of 790%. Folks, you cannot find return on investments like that in the stock market or real estate market. 790% 2-year return on investment is fantastic. Now let's take a look at what it would have been had my client fully implemented my plan in the year 2012. Well, on the left-hand side, we've already looked at that. That was actual 2013 with a fully implemented plan. That was the $12,073 of savings for the year. And to the right is 2012 with the perspective of had they fully implemented the plan, the part 2, which was the MERP, the medical expense reimbursement plan. Their savings would have been their taxes would have been $15,273, giving them an annual savings of $15,244. So the potential total tax savings for the 2 years, that's $27,317. My fees, $2,500. Their net tax savings, net of my fees, $24,817, giving them a 2-year return on investment of 993%. That's absolutely just awesome. Totally awesome return on investment for 2 years. This chart shows us the results of my client's fact set for tax years 2012 and 2013. Gold being the sole proprietorship results that my clients would have had they stayed in that entity as they had in the past. Green being the S Corp strategy as a standalone strategy. And blue represents the personalized tax plan I developed that utilizes both an S corporation and a sole proprietorship to maximize their tax savings opportunities over those 2 years. The sole proprietorship allows us to hire the spouse and take advantage of a medical expense reimbursement plan. Had my clients not met me and continued on their merry way with a sole proprietorship, totally unaware that they were overpaying taxes, they would have lost over $22,000 of wealth over the course of those 2 years. Had I prepared a quick and easy, give it no thought S corporation election type plan, my clients would have lost over $13,500 of wealth over those 2 years. But fortunately for my clients, they did meet me and invested $2,500 into a personalized proactive tax plan, which provided them with a 790% return on investment in 2 years. Folks, the unfortunate part is my clients were losing that kind of wealth for years. Sadly, so are most small business owners on what I call Main Street USA, because this kind of tax planning has not trickled down. I am able to save the average small business owner an average of $15,000 a year, each and every year. You may be one of them, or someone you know may be one of them. There is an old adage that states, it's not how much you make, it's how much you keep that matters. And I'm going to take it a step further and say that it greatly matters how you earn it as well. Operating a business and having choices on how you are taxed affords the greatest opportunities to save taxes and create true wealth. The rich and famous understand this, and they rely on tax planning professionals such as myself to deliver these kinds, if not more, tax savings. My dear people, you too should be able to take advantage of these opportunities. They're not just for the rich and famous. So I cannot stress highly enough the need for high income earners to invest in a proactive tax plan by a competent, licensed tax professional such as myself. I've invested tens of thousands of dollars into my professional education and designations over the past 20 plus years to bring high value tax planning to small business owners. It's unacceptable to me that small business owners and entrepreneurs are being deprived of their hard-earned entrepreneurial wealth because of a lack of tax planning. It's just unacceptable. This is what drove me online in the first place, to find a way to get this message out. You've seen it for yourselves in this slide presentation. Proper planning and implementation is required to produce these results. My client lost over $5,000 the first year because they did not implement one piece of the plan. Don't let this happen to you. Don't let this happen to your friends. Let's get this information out and let's get this proactive tax planning to Main Street USA business owners. I'd love to work with you, help you find that lost money and create entrepreneurial wealth. Please email me at emily@boltoncpa.com or private message me on Facebook, and we can discuss how I may be of service to you. And thank you so much for joining me today in this presentation. And if you found value in it, please do share the information and help others as well. Have a blessed day. Take care. God bless.